Building a passive income property portfolio, when should you go from capital growth to positively geared and passive income? And, how fast? Hi, I'm Jaryd Krause. I'm the co-host of the Property Powell Australia podcast.
And I'm Sam Powell. And in this episode, Jaryd and I have a really good discussion because it's a key question on pretty much every investor's lips that I get to have a lovely conversation with is, they want cash flow, they want capital growth. There is no, one size fits all. So we break down a few of the common questions to help people understand, when it is best to go for capital growth in their stage of life and when it's best to go, for those cash flow orientated properties.
Yeah, we talk about the difference between units, houses, regional areas, metros like Sydney, and we share a few data metrics on the growth rate of properties on average through Australia. We also talk about the 4-year rule that Sam has that shares with a bunch of people around holding property minimum times and how, what your loan to value ratio should be at different stages of your property portfolio to make sure you're covering capital growth and or passive in the way that's going to suit you best and your goals. So there's so much value in this pod. It's not the only way we can help you for free. Get our How to Maximize Your Borrowing Capacity mini course on the website. There'll be a link to that in the show notes. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Samuel, how are we doing?
Good, Jaryd. How are you?
Good. I got a question for you. Should I buy? Go on.
A burning question?
It's burning. It's. I've been sitting with this for too long. I just need to get it off my chest.
Right, I'm here for you. Hit me with
it. Thank you, as always. I appreciate it. Capital growth, I wanted to bring this up because most people listening are wanting to build a passive income property portfolio so they can have a better lifestyle. Who wouldn't? I mean, it's a great goal. And then you've got the equation of passive. We want to go for passive income. That's the end goal. But how much do we go for capital growth until we get to passive income? And what phase should we be doing when? And I just want to talk about capital growth versus positively geared property and passive income because we had Selena Kilcarney on the podcast, and she talked about how different property investing in Australia is compared to the States. And most people in the States are going for passive income, right? Mm-hmm. And they have a very different way of investing and multiple different strategies and ways that you can sell or exit on a property or acquire a property versus in Australia, we've got some pretty tough regulations, as we can see with lending regulations. And this being a long-winded question is
that's unlike you, mate, to have long-winded questions.
Yeah. And most people going for the Americans think we're crazy, just going for the slow burn of capital growth, but we don't really have the positive passive income that they can get through the different types of properties. So I was thinking about talking about the stats and the data between capital growth versus passive income properties. What should people do? Should they be going for capital growth or should be going for positive income? And who should be going for positively geared properties and passive income on top of positively geared properties, and when, and who should be going for capital growth based on different goals? That's my question.
Yeah, there's a few questions there, mate.
It's a podcast. That's why I brought it up straight away.
It's definitely on the lips of everyone, right? They come there, they get their purchasing capacity. They go see a really good mortgage broker. They should be seeing a really good mortgage broker. who specializes in whether it's property investment or owner occupiers. But basically, the key questions I'm trying to understand for people is what's your budget and what is your cash flow requirements? And by that cash flow, it's like, how much are you willing to put in on a weekly basis to hold your portfolio? The reason why I say put in is because in Australia, most properties, most good growth properties are negatively geared at the moment. And the premise around that is always, it's because I want to understand their risk appetite and their cash flow for their personal household, because there's no point investing in property for short-term gains, because by the time you get in and sell within, under a 4-year period, all your profits eroded through capital gains tax, selling fees, buying fees.
Right.
And that's like, what's your absolute maximum threshold? If it's, I'm happy to contribute after tax $200 a week, that's fine. It's trying to, get that strategy piece out to really understand, because I've seen investors get caught up in the marketing hype, and then they can't hold through the harder times where you've got, when you are invested, you go onto your phone and you see social media and you think, there's fires in LA, that means their economy is going to tank, and that's going to ripple effects to America, which is going to lead to Australia. And, can't sleep. I've got, my property investment in Australia, my one house and my one street. And emotion kills, most good investments over time. They say there's some of the best investors are the ones that forget their passwords to their stockbroking accounts, and it's funny to sort of see that, because a lot of what good fund managers do, and now good buyers agents do, is you're a bit of a psychologist to help coach people through the emotional waves.
Absolutely.
Going deeper into that, what's best, cash flow, capital growth. I said to you at the start, there's like an inverse correlation. And what that really means is, if you're seeking greater cash flow, especially in residential property and even commercial property, you're really going, I want cash flow because that's what I know I live off, and that gets me out of, the 9 to 5. It gives me the income today. You can go out to places like Broken Hill and get 10% yields, and you can achieve that, but then where's the growth? And the higher up the cash flow drive you go, it tends to lead to lower capital growth. And there is, like, you can go into your Sydney market and there's rubbish yield by cash flow, so it's costing you $500 or more a week just to hold these properties, and you do so on the proviso, or say, like, the expectation of good capital growth over time. But I believe that gets to a point when you're going into this, say, the Sydney market as an investment. If you're buying something that's in a really great location, it's $6 million, and it's renting out at $2,000 a week, which is a really poor yield. That $6 million, it gets to a certain point where I see that property is not going to go to $12 million as fast as a $500,000 property can go to $1 million, because you have less people playing in that pool.
Yeah,
essentially
less demand.
Yeah,
for that type of
so
property.
if I was like, it depends on your age, really. Like, if you're later in life and you're looking at retirement down the track, you shouldn't be going too far down the negative cash flow route, because you're looking for income to retire upon. So it sort of goes up that scale. If you're getting closer to that retirement phase where you can pull money out of super, strategies put into like self-managed super funds, and then you can withdraw that as well. You might even look at, instead, you might have a borrowing power of, or purchasing capacity, same thing, 750 grand. But instead of going to 750, you might put a 40% deposit in. So you've actually got less debt, and therefore the cash flow improves, and you've got an asset that gives you both capital growth and cash flow. It's as old Steve Policey back in the day used to say, is it's always case by case. But the one thing about investing is that the younger you are, the more time you have to recover, and so you generally take higher risks for the higher reward. And then at the back end, like if you want to have that goal of I really, really want to quit my job because I've been doing it for 40 years, 50 years, and I'm grinding it out. The like if something were to happen, like a black swan event, essentially, and then prices do drop by 10, 20% and stay down like what Perth did for like sort of a 10-year period prior to the COVID boom. It's not the best time to be an investor in that sense. So does that kind of answer your question?
Yeah, well, obviously the younger you are, I guess it depends on like how fast you want to build your wealth, right? Like you can typically, and we're talking about net wealth here, you can typically build your net wealth a lot faster through acquiring properties that are neutrally geared and or slightly negatively geared that can grow, like maybe they're a 500k property or 700k property in a regional area where the demand is higher than a $6 million property, say somewhere else. Those can grow faster and provide you a better ROI and like long term and build your wealth. For example, going for like units, like like it's crazy. It's a big discussion, but like a lot of people want to like just buy a bunch of units and just get passive income. But if you look at the rate of growth of units compared to houses, like you need to weigh up your opportunity cost. So I've got a statistic here that
I'll double down on that too. And there's units get clumped in between like townhouses, which are good for growth as well, that have decent yield. Units in small complexes under 15, they generally see good growth because they're scarce. There's a larger land content and people seek them out, especially developers. But majority of units, like the vast majority, are rubbish. So you really need to know. And when I say rubbish, it's like just not the best for capital growth. And even if you're not an investor and you're an owner occupier and you're listening to this, I'd say like you still should seek out properties that grow better in value because it's going to help your future self. Essentially, like you might want the nice views and the modern high rise, and that strokes your ego, but will you be there forever? Chances are not, right? So maybe you go to a 2-bed, 1-bath and a small walk up and you get the extra $100,000 in capital growth over the next 10 years, 5 years on top of that unit, which more often than not performs really poorly, and you have high body corporate expenses as well.
Right.
Your future self will thank you for it. So sorry.
And also like even then, like you can go the other way around of like instead of going to buy something that's a smaller place or not exactly what you would want to live in to build your wealth, which is like that's what we do typically for trying to build our wealth, is we're going to make some level of sacrifice to build our wealth, right? Like not pay ourselves first, but invest first, and have certain luxuries. But you could even go a step further, and like we've talked about in other podcasts, is like you could rent best and take that money and invest like not somewhere that you would like not want to live, but is a possibility of a place you want to live, but like invest completely where you would never live because you can get a better growth rate in maybe like, maybe you want to live in a unit and you could rent that unit in Surfers Paradise or somewhere beautiful. I'm not saying Surfers Paradise is beautiful, but like,
yeah, it is, mate. For the rest of the world, like get ocean, like
it is beautiful. Compared to other parts of Australia, maybe each their own, right? Different horses for different courses.
Bit of a trick there is buy the not so glamorous walk up with good land content, live in it for a year, and then rent it out, and then go and rent in the high rise unit with all the nice bells and whistles. But talk to your accountant about how to make the most of that 6-year ruling around capital gains tax exemption for
sure.
Yeah.
And over the last 30 years, up until 2022, this data shows that capital city houses values rose by 453%, where unit values increased by only 307%.
Yeah.
Which is massive to see. Like, there's 150% difference, and
Yeah.
and that's huge if you're trying to grow your wealth.
Yep. Yeah. There's scarcity element, there's affordability elements. There's obviously a lot to it. You don't know what you don't know, do you? So that's why we're here.
Yeah, exactly. And another one is like, the ATO. This is a stat from the ATO that they've recorded. Approximately 40% of investment properties in Australia are neutrally or positively geared, while 60% are negatively geared, showcasing that, like, obviously Australians love to go for capital growth. Like 60%, I don't know, some percentage of that 60% would be people that have, through that period of like the 90s, the 70s, 80s, and 90s, where we use negatively gearing for tax purposes. There's probably a lot of people still having those sorts of, like, sharing that strategy, right? Like, what's you're ready to speak to that? I'd love to hear.
You obviously, if you're not, we also have a YouTube channel that we record everything, so you can see our body language, and it's probably a bit more of an in-depth experience. Maybe, I don't know what it looked like on the big screen TV, but that would be awkward if you ask me. But some people like video, so we do both. Anyway, just be careful with data, right? Like, you hear these stats, it's just media marketing. Like, I get journalists, like, they come to me and ask for my opinion, and it's a very specific question. They've already got the article written. They just want a name to put in there, essentially. So don't do much of that anymore, just because doesn't reflect the true story. I'd rather do long form content podcasts like this. But yeah, be careful of the data, right? Like, you say, 6% are negatively geared, 40% neutral to positive. You can own an asset that is negative, and then because you've had it for 10, 20 years, it turns into positive. Like, right. And with generally the aging demographic too, they've held investment properties, and they've just paid down the debt, and it's always case by case on that front. But like, from an overall basis, Australia, like, from an international perspective, they think we're crazy with property. We've got an $11 trillion property valued market, residential, in Australia, and we've got about 2.2 trillion in debt. So, like, on a debt to asset ratio, it's really low. But the wealthy hold the majority of that, right? So us have-a-goers, essentially, are we leverage up a little bit more. The trend, like, is very strong for capital growth in Australia, just for the asset growth alone due to demand, and then you add on, obviously, inflation and currency debasement that we talked with Goose about. You really need to be invested in assets, and if the last 5 years hasn't shown you that, then I don't think anything will. But you hit a good point on about America too, which we should touch on later as well.
Yeah, just to make it tangible for people listening, is that, like, you mentioned, like, as you hold on your properties, they become more positively geared. When you're first starting out, if you're younger and you can make more sacrifices, you're going to build your wealth faster by going for capital growth and having maybe a higher loan to value ratio. If you can afford to make repayments or afford the maintenance on a property, if you are neutrally geared and or slightly negative, maybe like we said before, $200 a week or $200 a month. And then you can acquire more properties with more debt and have like a higher loan to value ratio across your whole property portfolio up until maybe you get to 45 or 50 and or 60. And then maybe you could sell some down and put some of that cash into, as those properties will increase in value, your loan to value ratio will decrease. And then you could, maybe just have a full positively geared property portfolio, or like 50% LVR or 40% or 30 or 20% LVR, and, be far more passive. And I think this is where most people struggle, I believe. And why I wanted to bring it up is because when our goal is to make passive income, and I've been doing this for 12 years now, helping people make passive income on the online business space, is we want to go for it straight away. We want to get to our goal straight away. And who doesn't want to get to their goal straight away? Like that's amazing. And then because of that, we can get so caught up in just that goal and just only focus on that and forget that like actually there's so many steps that we need to get to before we can get to that phase of like relax because we have passive income. And we go for our first property that is positively geared. And we're like, that can then damage our growth and how fast we can grow our wealth because we're going for something that's like, I only want something that's positively geared by X amount or this certain yield, right? And you've seen that, right, Sam? And that's why I kind of want to share this with people. It's like,
the hardest it's ever going to be is when you buy it because you obviously you lock in that debt. If it is interest only, then obviously that debt stays the same. If it's principal and interest, you're obviously paying down that debt, so the debt's becoming less and less over time. Your rents are increasing as well. So yeah, the most challenging part is always the first 4 years, essentially, and that's why I really bang on about 4 years. Some people are different; they might say 10 years, but with the advancement of data and everything like that too. And if you haven't listened to, we've got some really good podcasts with Luke Metcalf from Microburbs, and we've also got the Hashtag Analytics with Matt. So go listen to those ones. Like data is really revolutionising how we operate as humans, and the property landscape's changing because we can become more medium-term investors that can buy in and sell out to try and amplify returns if you've got that higher risk appetite.
Yeah. Question around the 4 years. It's typically going to be a lot harder in the first 4 years. Why is the number 4 years? Why is it not 3? Why is it not 6? Why is it not 10? Like what? How did we come to the 4 year range?
Because I did some calcs and like the average growth rate in Australia sits around 6% per annum, and if for 2 years, if it is just growing at that average, that's 6%, and that's if it's growing too. Because it doesn't just go into like a nice straight line up, right?
That's what we think our journey towards our goals is going to be. Super linear. Yeah.
Yeah. You hear all these things. I'm learning life as well, like as everyone else is. And you hear things and then you just let it go by and then it happens to you. And then you're like, oh yeah, you reflect back on what you've learned. So things come to you at the right stage. Answer to your question is the calculations that I did. Basically, if you're holding and selling within a 2 year period on the average 6% growth rate, you're really not even you're making very minimal return on investment because you've got
back your acquire cost and your sell cost, basically, right?
Yeah, you've got 5% purchase price on the way in with stamp duty, legal fees, and if you want to add in buyer's agent fees as well, and then then you've got selling agent fees, which sits around 3% in Australia. So, and there's obviously legal fees to sell out there, and then you got the capital gains tax. So you take all that out, like you've gone and risked. Say you did put $100,000 in, and it grows, and you've doubled your money in 2 years. By the time you sell it, you paid all those fees. You could have just gone and taken a lower risk investment for and gets somewhat similar returns. Obviously, if you go to a bond or a term deposit, then you still got to pay the income tax on those interest the payments that they pay to you. So they'll always have their handout taken from you. But the answer to the 4 years is, 2 years you're just wasting your time. I've seen now markets, like I used to be a little bit more long term, but I've seen obviously what's been happening in the Australian property landscape for over a decade now, and it's you can get really strong signs of growth in those 4 years, and there is that window where anything less than 4 years, I feel like can be you're never going to time the top, but you can make a decent amount of money in 4 years, sell that out, and diversify that into two different assets as an example. So
Yeah.
that's kind of that's just my round number that I felt that is worthwhile sticking to, and it's seemed to stand up test time.
Yeah, and it also lends to like why just go for capital growth and go long term, like minimum 4 years. Like sacrifice that versus like just trying to go for like positively geared straight away for 4 years and take money off the table when you could just keep it in, keep that money against maybe your, offset account if you are trying to go for positively geared for 4 years, and it's going to help you so much.
Yeah, well, another thing too is like what I've seen in markets too, because of the rise of data and the rise of buyers agents, like you can get markets that in 4 years double in value, and you've got to ask yourself, because property is not like shares, right? You can't just sell part of your property; you got to sell the whole thing.
Yeah.
And that's the massive downside of it too, and that's why I always advocate for diversification, not in just property, but also stocks and a bit of crypto as well. To each their own with their risk appetites, but that's generally like markets that double in value within a 4-year period. You got to sit back and ask yourself, like, is it going to continue on this? Do I take some chips off the table? Because markets that rise that fast, they also have the ability to pull back at a faster rate as well. And that's just what we've seen in like the data.
Yeah, it's a natural law. Like the velocity of something can go up and down, can reverse that way as well.
Yeah, Google mean reversion. That's something that I think Luke talked a fair bit about in his forecasting models, and a lot of the data scientists, they love the mean reversion comment, which, if the average is say 5-6% in that straight line, what you'll see is the straight line's sort of slightly going up, and you'll get these price growth up to like 15%, and then it'll pull back down to that 6%, and then it might kick up again, or it might pull back to a negative. That's where utilizing, smart buyers agents, property data specialists, things like that, where, your risk appetite, you can go into places, that are more volatile. So you're taking that higher risk. You want that higher return, but you can't turn around if it doesn't work out and say, "Oh, that sucks." It's like, well, and blame somebody else. It's pretty much you're taking the higher risk on the expectation to gain those higher returns, but you're also understanding that there is the higher downside risk as well. But with an educated process and looking at supply and demand metrics, you're reducing that risk every step of the way. And I guess that's why people are really attracted to looking at property data as well. There's a bit to it. Sorry.
There's a lot to it. In fact, like the reason I wanted to chat about this is because, capital growth versus passive income straight away, and talk about a bit of that capital growth data metrics. But just the guys listening, revert back to our podcast with Luke Metcalf. It's episode number 64, and that's part 1, and 65 is part 2, capital growth data metrics to user Australian property. It's funny that episode 65, which is part 2, is one of our most popular episodes. Normally part 1 would be, but obviously part 2 is crushed it. So guys, check that out on all the platforms or YouTube. But that just backs up why capital growth and the data is so valuable and so important to go for that capital growth over positively geared passive income straight away.
I'm just surprised that our first episode isn't the number 1, mate, because we were so green and rookie.
Could be because we're green and rookie, but I think we're just like fine wine, Sam. Anyway, I hope we are.
Yeah. Put a comment below. We're always looking for ways to improve.
Absolutely.
Definitely don't know everything, but we're here to help, obviously. And like, I was talking to the team today, like, we're better and we're stronger together as we grow, and like seeing more and more now. This is going more the philosophical stuff that Krause and I love talking about, but the world is making us, more divided, right? Like we're working from home, or we're working in front of a computer, or we're having less quality relationships in our community because of technology sort of taking us apart from that. And I think if what would happen if the internet got switched off? Like we need to learn to
scary thought
to work as a community, and you're not getting doomsday. I'm in my what's that? The green army shirt. I'm not trying to do that.
He's ready for war. Sam's ready for war.
No. Well, we're in the interesting times, right? I think there's a lot of opportunity coming forward in the next couple of years, but it's not going to be without its ups and downs. Challenges. Just like property markets, cyclical seasons.
Embrace the challenges though, because that's where the growth comes from, and character building, and I mean we don't achieve anything without some sort of challenge. So guys, like Sam said, send in your questions. Listeners' questions are absolutely awesome. Helps us help you better, and thanks for listening, and we'll speak to you on the next one.